going to be a lot harder in a period of high inflation. All right, it's going to be certainly high inflation. The Fed is no longer your friend. Stocks and bonds tend to positively correlated, so your 60-40 portfolio doesn't offer the same level of diversification. So as a whole, I would think with the next decade for asset allocators, the investment management industry is going to be a lot harder. You're going to have to work for return instead of just being lifted by a rising tide.
On today's episode of the What the Finance podcast, I have the pleasure of welcoming Vincent Deluard, who's Director of Global Macro at StoneX Group. So, Vincent, thanks for joining the podcast today.
Pleasure to be here.
No problem. And yeah, I'm really looking forward to the conversation. So, let's be honest, last quarter and the start of this year, it's been pretty crazy. Lots of stuff has been happening. So, from your perspective, what are you really seeing in the, I guess, the global macro landscape?
Well, as you mentioned, I mean, the reaction on especially the bond market has been kind of crazy. I mean, we had these insane moves, especially in the front end of the current 2-year. I mean, it went from pricing, Fed funds rate of people are talking about 6%, and then in a couple of weeks after that, I mean, it's just like cuts all the way across. Now we have a little bit of hindsight on the banking crisis, which is not over by any means. But it's certainly not looking to be the Lehman Brothers moment that, at some point was priced last month. So my general take is that we had a bit of an overreaction. We have a market that's been clamoring for rate cuts for years now. And it seems that market participants are really looking for anything that might justify their bias, the prior, right? They have this bearish bias and they want confirmation. And they saw the banking crisis again, which is real and which is not over. We'll see more banks fail. We'll see more commercial real estate trouble. I'm not claiming that. But to jump from what seems to be a regional issues, which is fairly easy to understand. I mean, it's the most widely telegraphed crisis in the history of a crisis to a global recession. I think there's a leap that a lot of people have just made out of faith, and that doesn't seem to be supported by the data, at least until now.
Yeah, it's really interesting. So are you thinking this? So beforehand, people were thinking, if they were going to tighten too much and something was going to break, something's break. Now they're thinking they're going to loosen really quickly. So do you think it's something in between, or what are your thoughts on what we could see happen?
You mean on the path of monetary policy?
Yeah.
Or okay. Yeah, I think even Powell doesn't really know. That's why you've seen so many kind of contradictory messages coming out of the Fed. I think they're just kind of testing the water, sending balloons left and right. This is an interesting moment, right? Because we're getting to the point where inflation, at least as measured by the CPI, is now 5%. Fed funds rate is going to be there in one meeting. I think the Fed is pretty happy with what they've done. I mean, no, not that on the big picture, they're not happy with what they've done, but they're happy with the way things have turned out in the past year. I mean, it's pretty much what they wanted, right? They were able to raise all the way to 5, which, I mean, I was not in that camp, but a lot of people, I would say most economists were saying, the Fed's going to break things as soon as the Fed funds rate goes above 2.5%. We're going to have the same kind of issue we had in 2018, 2019. No, by and large, it's fine. Like, the job market is still strong. The economy is slowed, but not fallen into recession. Yes, we had issues with Silicon Valley Bank, but, that was so far contained. So now, and inflation CPI has fallen exactly the way it should have, right? I mean, we had the core goods that cleaned up after the supply chain issues. China reopened. Base effect in commodity sectors has been okay. We haven't had an oil price shock, which I still think is a risk, but hasn't happened yet. So now, yeah, I mean, I think the time for the Fed is you do 1, maybe 2. I would be in the 2 camp on the margin. I think they do 1 more. And then you just wait and see what happens. But to jump to the notion that they're gonna have to do like 3-4 cuts, as is currently implied by the market, I think is certainly the timing of that is too early. I mean, maybe one can make, we'll see, you know, the economic future is always uncertain. There might be some sort of shock that I'm not seeing that will justify this. But for this to translate into the data, it's not going to be a summer of 2023 thing. It could be maybe a late 2023 if something breaks.
Yeah, definitely. That's interesting. And I know you were one of the first proponents, sort of, people talking about inflation in 2021 because you saw these sort of challenges. And obviously, we saw that happen. It has dropped a little bit since then. But what were the things you were watching out for then? And then you said that a few of them have been resolved, supply chain issues, other factors. Do you think they have been resolved, and maybe we're not going to see that inflation in the future? Or what's your opinion on that?
Well, I think you need to make, you know, a couple of distinctions. Distinction between CPI, which is a statistical measure, which, you know, like any measure has its flaws, its bias. You know, I'm not claiming there's any sort of grand conspiracy to, you know, but you know, there's difference between them, the concept and the thing. There's a difference between the measure and reality. I mean, even the words we use, and the CPI is not the thing. The CPI is a concept. So we need to make the difference between the CPI and inflation. So to me, CPI is falling, and inflation is kind of a broader phenomenon. You know, with social, economic, political implication or cultural almost over time. So that's the first distinction I would make. Second distinction I would make is the distinction between cyclical and then structural inflation. Even in periods of high inflation, like the 70s, you had periods of very rapid disinflation. You know, you look at the CPI in the 70s, I mean, you have, you know, goes up in 71 and comes down a little bit, another spike in 73 after the oil shock, all the way to, I think, 11-12%. And then from 73, it goes down to 11-12% to 4% during the 74-75 recession. So you had a really big disinflationary process. Now, we were still in a high inflation era, and the way we learned that ex post was because inflation did not fall back to 2%, kind of stayed at 4%, and then it picked up again in the second half of the 70s, all the way to you know, 15% above after the second oil shock. So you can have disinflationary episodes within inflationary eras, if you want. I think that's where we are now, and I also think, yeah, I'm not questioning the disinflation right now. CPI is falling; it'll probably keep falling. I don't think it falls all the way down to 2%. I mean, a lot of that will depend on commodity prices, but my expectation is that we you know, commodity. I mean, you never want to bet the house on oil prices, right? I mean, if you're if you need this perfect alignment of stars, you just, yeah, okay, maybe you get lucky, but you know, luck is not really a plan. So yeah, inflation, CPI keeps falling, but it doesn't go back to 2%, and then my view has been that we are in this kind of structurally high inflation world where you know, 3-4, maybe anywhere between 3 and 5%. We'll see where it falls. Is the new normal for really structural forces which have nothing to do with COVID. I mean, COVID kind of pushed us over the top, right? COVID pushed us to 9%. COVID was the Ukraine war. And it's hard to do counterfactual history, but my base case is that even if we had not have had these events, we'd still be looking at a structural rise in the inflation rate in the past 3-4 years. And I would argue that's not a bad thing. Like I think that's the part where I'm a bit different from a lot of the inflation crowd. I mean, a lot of the inflation people ultimately are just trying to sell you Bitcoin and gold. And you know, they have this kind of like skies falling mentality. Oh, they're gonna debase the dollar, and you know, they're gonna print away. Wow. No, I mean, there's nothing magical about that 2% target. It's kind of, I would argue, it's an artificial constraint we set on ourselves, and I think we'd be much better off if we agreed that, yeah, we want to. I think what an honest central banker should say is, I want to avoid extreme outcomes. I want to avoid, you know, deflation, because you know, we know that tends to be bad for economic growth, and we want to avoid scenarios of, you know, very high inflation, because that also creates so much uncertainty that the economic machine, you know, starts to sputter. But in that range, and I would define it broadly as between 1% inflation to 7% inflation, I think it's, at the end of the day, it should be a political decision. inflation has some redistributive consequence. It has some effects on growth that you know, in some periods, like I would argue the past 20, 30 years, when you have very strong disinflationary tailwind, you can have a low inflation target, which is what we had. That's why we could hit 2%, right? If anything, we are, you know, Europe and Japan were constantly below. The US, even after 2014, constantly missed. So that 2% was almost too high because we had all these structural forces putting inflation down. But when you have an era, which is like the one today, where you have, I would argue, a squeeze on the labor market, structural, you have deglobalization, you have massive generational inequalities. I would argue that a high inflation target is probably what you need. You just don't want that to go out of control, which is where we are. I mean, that's it. Like I think there was that fear in last year when we went to, you know, 5, 6, 7, 8, 9, that it would spin out of control. We've avoided that scenario. Now we just reset at a high level of inflation, high level of nominal growth, high level of interest rates. And that is, to me, a much better outcome than trying to engineer a massive global recession, send millions out of work, create another debt crisis, create balance of payment of crisis all across the world, all that to get to a target that is kind of meaningless to start with.
Yeah, you covered so many great points there. And you mentioned the 70s, but it'd be really interesting to hear your thoughts about, I guess, after it peaked, inflation, I think it was early 80s, and then the trends and the tailwinds that we experienced until, I guess you could say the last 40 years, and then maybe why that has shifted. You mentioned a few of them there, but maybe you can go back into the past, what really benefited, what caused lower inflation, and maybe why that's changing now.
Yeah. So, I mean, for the immediate disinflation of the after the end of the 70s, you know, a lot of that has to do with really Volcker just, you know, jacking up the rates all the way to, you know, 18, 19% overnight. Then there was demographic changes, right? I mean, some of the great inflation of the 70s, I mean, you know, you had the breakdown of the dollar, but I think primarily it was the baby boomers who were turning. So boomers were born from 44 to 65. So by the 70s, most of them were entering their early 20s, which is when, you know, especially back then, household formation was a lot earlier, right? You didn't have roommates back then. You didn't stay with your parents. You could actually afford homes. So, you know, they were buying homes, they were buying cars, they were buying dishwashers, whatever. So you had a huge increase in aggregate demand without a commensurate increase in aggregate. And that was supply, and that was a global phenomenon. I mean, this was the time of the demographic time bomb, right? The Club of Rome. We're going to run out of everything. I mean, you had this massive, you know, baby boom urbanization worldwide. And then that starts to ease in the 80s because the boomers now are starting to work. So what used to be a demand shock becomes a supply shock, right? We are getting more and more productive workers who are, you know, turning from net consumers to net savers. So inflation starts to slowly fall. And then the icing on the cake really was the what's been dubbed the great doubling, right? Fall of the Soviet Union and the Berlin Wall. Suddenly you have all the commodities of Russia that were kind of closed off in the Soviet system that become available to the rest of the world. And then more importantly, the opening of China. I would point out, I think if you want to date, probably 1992, 1993 is the big Chinese yuan devaluation. So the yuan is devalued by about 70% in 2 years, just as the Chinese economy is opening up. This is you know, they opened the first special economic zone in Shenzhen, then Xiaoping, the 4 modernizations. So China opens itself. It's got 1 billion people. And they also had a massive influx of workers, because if you look at Chinese demography, there was basically 10 years in the 70s when China was rich enough to actually feed its babies, and people were still allowed to have them before the one-child policy. So you had this kind of delayed baby boom in China, which means that you have all these workers coming into the labor force in the early 90s, just as China is opening up with an extremely undervalued exchange rate and a closed capital account, meaning that the money kind of gets trapped in China, and then China has to keeps undervaluing its currency. And then that model gets spread across East Asia through the East Asian financial crisis. Because of Chinese competition, suddenly you have balance of payment crisis in Thailand, in Indonesia, places that used to do the stuff that China is doing that now being undercut. Now they can no longer afford their fixed rates. They have to devalue by 80% as well. Like that's what happened in Indonesian rupiah, the Thai baht, Korean won. So now it's not just China, it's China plus all of Asia that's doing the same mercantilist policies of exporting surpluses to the West and then reinvesting these surpluses into US treasuries, keeping long-term yields down, lowering the cost of capital in the US. So it's a perfect storm. And coincidentally, this is coincidentally, this is the same time that you heard the term great moderation in the US. I think it was Greenspan who says it first, 1995 speech. Now, Greenspan being Greenspan, he takes credit for it. Oh, inflation has fallen because I'm the maestro. This is a time when you put central bankers' face on Time magazine, the committee to save the world. And Greenspan loved the attention. So yeah, inflation disappears from the West. Part of it is just Walmart. Walmart. Here you go. I mean, if you look at the US CPI, it breaks down. Before it used to kind of grow together. And then you have two CPI. You have the China CPI, basically anything can buy at Walmart, where things are coming down fast. It's toys, it's electronics, it's garments, TVs, it's computers. You have 2% deflation every year in these items. And then you have the US CPI, things that are made in the US, things like shelter, healthcare, health insurance, childcare, where it's growing at 4 or 5%. And that's my view. We've always lived in a 4 or 5% inflation world, which didn't know because we had the Chinese CPI, the Chinese CPI shock. Last but not least, next thing that happened, always, I'll go back to the early 90s here, is the tequila crisis. So that's 94, 1995. The Mexican economy just completely crashes. The peso is devalued by 80%. At that time, you had a lot of young Mexican entering the labor market, no ability to provide jobs for them in Mexico. What do? They cross the Rio Grande. Over the next 10 years, you get 10 million workers, Mexican workers, coming to the US. Hugely deflationary for services, agriculture, manufacturing. The minimum wage gets stuck for 15 years because we have cheap capital from the surpluses of East Asia, cheap goods from East Asia, and then cheap labor on top of that from Mexico. Of course, we're going to have lower inflation. I mean, that's a given. Now, does that mean that we should have a 2% inflation target forever? Absolutely not. If conditions change, you should change your target.
And those conditions, a lot of those conditions are changing, would you say? So, you could say maybe there's still that immigration potentially, maybe not from Mexico, but other sort of South American country or Central American, or has that changed? How's it changed?
Yeah. So let me go back to the three things, like cheap capital, cheap goods, cheap labor, right? Cheap capital. Well, cheap capital was basically foreigners recycling the surpluses into the US. Seizing their reserves without illegally is not a good sign. When we seize the Russian reserves, basically that's when we send a signal to Saudi Arabia or to China. It's been going on. Foreign central banks have not added to the treasuries holdings of treasuries since 2014, basically. And I'm not going to get as to why. It has to do with geopolitics, has to do with their own dynamic. As countries age, they need to start drawing from their accumulated savings. Of that, to me, that is the main driver. And then you add on that the geopolitical stuff. Basically, we will no longer. I mean, as the issue of the global reserve currency, we can always have some captive demand for our treasuries, but not as much as we used to, right? So we have less cheap capital. Also, just because the surpluses are melting abroad, right? You look at Japan, Japan is the largest holdings of US treasuries of any country. Japan current account is not a deficit. Germany is getting close to there. So structurally, there's just less ability to produce the savings that the US needs. So we have less cheap capital, cheap goods. Well, we don't want them anymore, right? I mean, that was Donald Trump, right? We don't want, cheap Chinese stuff taking our job. We're going to put some tariffs. We're going to, bring back the semiconductor home. We're going to reindustrialize. And also I would argue that China is no longer able to produce these cheap goods because China is quite wealthy now and it's aging a lot more rapidly than the US. So it's really a push and pull, right? The US is breaking down the China America thing, but China itself no longer needs to be the manufacturing hub of the world, because they no longer need to create 10 million jobs every year. If anything, they need to destroy 10 million jobs a year. So that's gone. And then on the labor, yeah, we're pointing Mexico. Mexico is aging much faster than the US. We actually have net negative immigration from Mexico at this point, because we have a lot of Mexican workers who, come to the US, made good money, and now they want to retire in Mexico. We also have a lot of, American hipsters moving to Mexico. I mean, I was in La Roma in Mexico City for a roadshow 2 months ago. La Roma is this kind of like really nice, cool neighborhood. Mexico's a great city, and everybody there was American. It was all this kind of work from home type. You priced out of the Los Angeles and New York. They can rent an apartment in a beautiful leafy neighborhood in Mexico City with good vibe for a couple $100, $500, $600 a month. I mean, cannot even get a garage spot in New York for that price. So yeah, so these three things are falling at the same time. And I would argue that, your optimal level of inflation, which probably was around 1.5, 2% 10 years ago, is probably now around 3.4, 3 or 4%.
Yeah, that makes sense. So then would you see at the same time, we mentioned that services have really increased quite a lot over the past 30 years. Would you see the products increasing at a similar rate, or could there be a massive spike to start with when there's that onshoring or the friendshoring, all that other stuff, and then it could sort of flatten out a bit, like we've seen? What's your thoughts?
Yeah. Well, first of all, service matters more and more, right? Just as the economy becomes more service oriented. I mean, that it's called the Beaumont effect. I think is your as productivity increases, the share of your low productivity sector grows, right? So that's almost a construct, right? So we spend more today on attorneys, higher education, childcare than we did 30 years ago, when a bigger share of your basket went into goods and food. So there's that effect. On the price of goods, we'll have to see. So far, it seems to me that the whole decoupling, reshoring is inherently inflationary, and you see that, for example, on the chips side. I mean, we have this massive Chips Act where we incentivizing TSMC, Micron, Texas Instrument to reshore, move away from Taiwan, Southeast Asia back into the US. What they're discovering is the cost of a really high-end engineer in the US about twice what it is in Taiwan. The cost of land is higher. The cost of building is higher because you have all these cities with it, but it's okay now because they get the subsidy, right? So I mean, it's happening. Like, you see all these fabs being built across the country just at a much higher price.
Yeah, okay, that makes sense. So,
and that price is kind of shielded from them at this point because of the subsidy, but ultimately someone's paying it, right? It's coming off the deficit, but the cost is inherently higher.
Yeah, and that's actually where I was going to go. So the cost of capital, and that the fact that all these international countries have been willing to buy these bonds for the past 30, 40 years, it's really been, well, especially recently, allowed the US to have that deficit and basically sponsor it. But then these countries needed it because there was sort of a shortage of US dollar liquidity around the world. So if we were to see the potential of these countries having to sell, and we see all this, I guess, US dollars coming back to the US, could that be another, or what's your thoughts on that? And then what does that mean for the deficit?
Yeah, I mean, I am, in general, I'm not a deficit warrior, like, because I've heard that for 20 years, right? Oh, foreigners are gonna sell, and the US always seems to be able to find someone to buy its debt. Now, that doesn't mean that the dollar always goes up and yields always go down, but and I also kind of have an MMT framework of if you issue currency, the rules of gravity don't apply to you, especially if you issue the global reserve currency. Now, with that caveat, I am worried in the short term, especially because of Japan. I think for now, the one you want to look at, you want to make that kind of global foreigner stuff going on is Japan, where we had yield curve control, negative rates or zero rates for 20 years now, and now you start to see inflation in Japan, like actual inflation, wages going up. You have a new governor coming out. So at some point, that Japan is going to break that that yield curve control policy. You could see, Japanese yield curve shift higher, yen goes higher, and Japanese banks, insurance start to repatriate. Now remember that Japan has the largest net international investment position, meaning that Japanese own a lot more assets abroad than foreigners own assets in Japan, especially in the US, right? I mean, because the JGB was repressed for so many years, a lot of institutions move their savings into the US. Now, if you see that come back, yes, I think you could see a short-term shock to global yields. I think we'll have the first press conference with the new Japanese governors next week, so we'll have more indication as to. But I would give it 1 or 2 years. I think this is going to happen. I don't know if it's a 1 month thing or 1 year thing, but that's going to happen. So yeah, I would think that rates need to move higher, especially long-term yield in the US. I think 4% is we were there 6 months ago. I think we can go even go above 4%. I am not too worried about like I said, the sustainability of the debt, because at the end of the day, you can always print more. And if you have good nominal growth, that's the part that all these debt warriors don't get. Right now, if you look at US debt, net of central banks holding, because I would argue you need to cancel that out, right? If the Fed owns treasuries, it's a liability, a claim of the public sector on itself, right? You could just cancel it out. If you cancel out the Fed's holdings, we actually have a lower debt to GDP ratio now than we had before COVID. And that's because nominal GDP has been expanding by double digit. We had like 9% inflation, and 2021, we had like China level of growth. So again, you can get out of a debt crisis by growing. That is the best way to get out. Actually, I would argue that is the only way. We've tried the whole austerity thing in Europe, and then you shrink the numerator and the denominator at the same time. It's way better to inflate the denominator, which is what I think we're doing.
Yeah, it's interesting and funny how you mentioned Europe. That was my next question, because I guess it's almost like a different trend. So especially the UK, you could say UK is sort of quite unique. Inflation has stayed quite high there, and then in Europe it's remained high as well. So do you think they will have sort of different, I guess, average inflation numbers as well, or like average inflation, like the ideal average inflation in the coming years?
Yeah, I think that the phenomenon I'm describing is global, right? It's a lot of the things that, cheap capital, cheap goods, cheap labor, all that. Europe is slightly different types of shocks. One deflationary shock for Europe was the fall of the Soviet Union, and then suddenly being able to access the incredible wealth of natural resources of Russia and the cheap labor of Eastern Europe. So that was our own deflationary shock, and then we compounded it stupidly by having austerity in 2010s. Yeah, if you look at these things, they're also going away, right? Obviously someone blew up Nord Stream 2. And I'm just gonna say it was not the Russian. So we don't have, if you look at German industry, it was basically effectively subsidized by Russian gas. The labor from Eastern Europe, you go, the countries that are aging the most rapidly outside of South Korea and Taiwan are all in Eastern Europe. It's like Bulgaria, Romania, Poland. Now you have these villages that are full of 80-year-old people. So we no longer have that, and also we don't want it anymore, right? A lot of the Brexit vote was about migrations from Eastern Europe to the UK. So that's kind of gone at the same time. And then austerity. Well, we cannot have austerity anymore, right? Because we need to, we need to write more checks, right? COVID, then Russia shock, the inflation shock, the pension shock. There's always a reason to bust the budget, which I'm not necessarily against it. I'm a believer in fiscal spending. So, but that would argue for a structurally high inflation, which I think people are aware of. They just don't want to say it publicly. But there was this interesting press conference by Lagarde last week where she started to say, well, we're getting all these changes. And, I think what she was trying to do is took her a while to figure that out, because she's not the brightest bulb out there. But, she was still in the transitory inflation camp for way too long, but now it's gonna be really hard to get to 2%, and she's trying to shift the blame, right? It's not me, it's not because we kept the rates too low, it's because of all this stuff. So I think you'll see Europe adjust to this higher world as well, higher rate, high inflation world as well. I mean, they don't have a choice.
Yeah, exactly. Adapt or die, basically. So if we look at the past 40 years, the opposite trend was very beneficial for basically all assets. Most of them appreciated. What do you think this new, I guess, normal what impact do you see it having on assets? I know that's a broad question, but
yeah, no, but it's the right question. I mean, it's yeah, and I kind of agree with your assessment, right? Everything went up, right? It's the everything bull market. From that, late 90s, early 80s moment, just everything went up, right? If you own the 60-40 portfolio, 60%, I mean, what a golden age for finance people, right? Just, hey, put people on 60-40 and you get like 9-10% clock, like a clock. And there's a little accident in the way, but take that out, just, you didn't have to do any work. I could just hit the golf club at like 3 p.m., put your client in balance fund and don't worry about it. And then if you're a little smarter, you risk parity, you just lever up the bonds a bit, and you get to 12-15% and you get to charge 220. What a joke. So that was a great environment. And ultimately that great environment was supported by falling inflation, which led to falling rates, which led to everything moving together up. And it led to also having this negative correlation between stocks and bonds. It's going to be a lot harder in a period of high inflation. All right, it's a period of certainly high inflation. The Fed is no longer your friend. Stocks and bonds tend to be negatively correlated, so positively correlated. So your 60-40 portfolio doesn't offer the same level of diversification. So as a whole, I would think with the next decade for asset allocators, the investment management industry is going to be a lot harder. You're going to have to work for return instead of just being lifted by a rising tide. And I still think that one of the biggest implications is reduration. For the past 4 years, you can make money by extending the duration of your portfolio, and to a lesser extent, extending the credit risk of your portfolio. That's where you earn that extra return. Now I think that extra return from duration certainly is going to be negative. From credit risk, it always depends on the quality of the issuer, but a world of higher rates is generally more unstable. So I would expect, I call that the nuclear winter of the 60-40 portfolio 2 years back. I don't think the 60-40 portfolio will beat inflation over the next decade. It may have some positive nominal return, but on an inflation adjusted basis, it'll be kind of like the 70s. You'll be losing purchasing power.
Yeah, it's interesting. And as you said, it's the people probably can't just be passive. They have to be more selective in what they're investing in. So if we look at the 70s, gold obviously performed quite well, other commodities quite well. Do you see it? There's been talk of this commodity super cycle. Do you see something like that happening, or is that maybe a bit overstated?
Yeah, I mean, one thing that was going on for gold in the 70s is, we had a 20-year, 30-year suppression on the gold price via the Bretton Woods system, right? So you readjust, I mean, like the jump, it's like a rubber band, right? I mean, the jump was huge. I mean, I'm bullish on gold. Obviously, I like the fact it's trading more than $2,000. I think it's, great store of value, had its, 10,000-year track record, all of that good stuff. But we're probably not going to repeat the 70s. But, you can still have a good, can still be bullish on the asset class without thinking you're going to, get a 10,000% return. Commodities went up also around the 70s. I would also argue for the same reasons. They were artificially suppressed. I mean, if you look at the oil market, right, we basically had the Seven Sisters, the Rockefeller empire that basically controlled the price of oil, which is flat, and then suddenly that when you remove that, you saw the nationalization of oil resources across the Middle East, the breakup of the Seven Sisters, all that stuff. So there were some unique factors about the 70s that were uniquely positive for commodities. Now, that being said, I still think we have other factors that are positive for commodities as well now. I would say a decade of underinvestment. That's a big one. Last year, I've never seen this, like XLE, the energy ETF in the US, biggest energy ETF, up 100% point versus the market. Net outflows. I mean, this is insane. And a lot of that has to do with the ESG movement, divest. So that just means that, yeah, you see the investment numbers. Like, if you don't have capital, well, you don't have investment. If you don't have investment, you don't have no new supply. So we have, I think, a tight whole market. And then the other thing that I think will push out inflation, at least in the short term, commodity inflation, is the green revolution, right? If you look at the numbers, the amount of copper we need or lithium we need in order to accomplish a target, it's like this arms race now between governments. Oh, I'm gonna be fossil fuel, by 2030, no, 2028. Guys, you look at the periodic table. Like, look at how much zinc, lithium you need to get there, and you add all the targets. You're exceeding the global supply, and anything that might be underground by an order of magnitude. So that would argue for higher commodity prices as well.
Yeah, and I guess they're an asset that hasn't performed, I guess, in the past few years. They have, but previously they haven't performed too well for at least the past 5 years. But if we go to maybe the opposite, so tech stocks or tech companies have sort of been the beneficiary of low cost of capital. So I feel like, do you feel like there could be a change there as well, as cost of capital increases, and it might need, would you need sort of government supported, I guess, investment like we're seeing with semiconductors? Do you see that the way forward? Or?
Yeah, no, absolutely. There was I mean, the in general, a low cost of capital is just the discounted cash flow model, right? I mean, if your cash flows are stacked far in the future, which is the case for a lot. I mean, that's the pitch for startup, right? It's like, oh, Amazon never made money in the first 9 years of existence, right? But just give me time and I'll just mint money, which is not entirely, I mean, not always false, right? I mean, Amazon was real. I mean, Apple, I mean, I'm not saying these things are not true, but the value of this cash flow profile of invest a lot now to earn a lot more in 20 years works best when you have low yields, right? I mean, it's just the compounding thing. So if we move to a world of higher rates, yes, that is a sector that would suffer the most. Now the question is, do we, there's a policy case to be made that, we want to keep that. We want to be the leaders in artificial intelligence. We want to make our own chips, our own batteries, all of that. Now, if we can no longer have the private sector finance it because rates are higher and everybody wants to buy T-bills instead of, putting money in the vision fund, there'll be a funding gap here. And I think what we are seeing is government stepping in and saying, well, no, I want to be the global leader in batteries. I want to be the global leader in artificial intelligence. Everybody wants to be the global leader. Maybe we see the government sector take over a lot of this now unprofitable investments.
Yeah, but we might see less venture capital companies sort of discounting out groceries and, and food deliveries and other factors. But Vincent, thanks so much for your time today. I really appreciate it. So I guess my last question is, what is one message you want people to take away from our conversation?
Maybe don't get fooled by the fall in inflation. It is happening, but that doesn't mean it's over. And then if I may add something, I think the general bias still is overly negative on the economy. I think if I'm right about moving to a new era of higher growth, higher rate, we'll be surprised by the economy's ability to handle this world. And that's not necessarily a bad world. I mean, I would argue, tell people, stop fighting it. Stop trying to get back to the old world. The old world is actually not that great. And I see the market as a whole do that. I think a lot of that kind of negative self-talk, the Fed is going to cut rate, we're going to have a recession, is really just the ghost of the 2010s being applied to a period that's fundamentally different.
Yeah, as you said, inflation isn't the issue. It's more the stability of the inflation, which will be key. Yeah,
right.
Yep. Thanks again for your time. So if anyone wanted to find out more about your work and what you do, where would the best places for that be?
Sure. So I'm the global macro strategist at StoneX, which is a global financial service company with actually big presence in the UK as well. So if you're a client, well, great, good for you. Just ask your sales rep to get on my list, and then we'll make that happen. If you are not, go to my Twitter handle at Vincent Vincent dot no, there's no dot, at Vincent Deluard, Deluard. If you go to my pin tweet, there is a link. You can sign up for a free trial. And if I think it's 1 month, but if you ask me, I'll gladly give you an extra month. And then you can get the work there. I think it's very competitively priced. We work with institutions all over the world. And yeah, I mean, also reach out on Twitter. I mean, I've learned a lot I've benefited from people on Twitter helping me out. So I'm just trying to give back. And I mean, that's the great thing about Twitter is like, yeah, you get all the dumb stuff and the bad on jokes, but if you're nice, people are nice, and you can learn a lot from people from all walks of life. I mean, I talk to farmers, I talk to like regular people and some of these questions are really, really smart. So I always welcome engagement on Twitter.
Yeah, great. I'll put that in the description below. And yeah, I think you just need a good filter out where you're not interested in and all the nice stuff you try and pay attention to that. But yeah, thanks again for your time.
Thank you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.